Hey everybody, it's Ryan here. The reason why I'm making this video is because I get this question a lot. Whenever I make TikTok videos or any short form content about the IUL, I get a bunch of comments of people being like, why the hell would I pay interest just to take a loan from myself, just to loan my own money? That makes no sense. The IUL sucks. You know, I get tons of comments like that. And the second I get that comment, one, I know that the person has no idea what they're talking about, because when you take a loan from your IUL, you're not actually borrowing your own money. You are actually using the life insurance carrier's money while your money continues to sit in the IUL earning interest. That is how you are able to have uninterrupted compound interest inside of the IUL. So, I get a lot of comments of people trying to talk down on the IUL, but they simply just don't know what they're talking about. So I get this comment so much that I decided just to make a video discussing literally that breakdown specifically. So let's break this down. What I have in front of you guys here is just an illustration of an IUL that I structured. Now, this structure is a high cash value IUL. That's the only IUL that I structure. I structure IULs with the emphasis on cash value accumulation, not a big, large death benefit, right? So here on this first column that I'm going to highlight here with my mouse, I have a 28-year-old male who's contributing $24,000 a year, which breaks down to $2,000 a month. And so this accumulated value right here, think of this as a balance inside of your high yield savings account. Now, when you open up an IUL, think of an IUL as like a parent company, for example. This is like the easiest way that I can explain it. So the IUL is like a holding company, basically, right? And then you have like two sister companies, for example. So you have your cash value accumulation, which is basically your high cash value accumulation account. And then you have your net surrender value, which is essentially your line of credit with the insurance company. Think of this as basically the insurance company gave you a credit card, and this is how much money, this is your spending power on that credit card. That's, the easiest way for me to explain it. So the amount of money in which you're earning interest on, so, every year, how I say that the 30-year historical average for this specific IUL, the way that I structure it, is 17.5%. That's the 30-year historical average. You're earning that, that interest on this column, the accumulated value, okay? So when you are going to get paid on interest, they look at how much money is in this column here for that specific year. Now, the growth in this policy is just assuming 7.1% in all years. So the growth that you're seeing here is based on 7.1%. Now, to answer the question, why would I take out a loan and pay interest on it? Like, why would I pay interest on a loan of my own money? Well, you're phrasing the question incorrectly. You are not taking out a loan on the money that you're borrowing from yourself. Because again, you will never touch this money in this column. Or should I say, you should never. Don't touch this. There's no reason to touch this money. This is your money. Think of this as money sitting inside of, again, a high cash value or a checking or savings account, right? So, for example, I have some cash here. If you have $30,000 sitting in your checking account and you go spend that, that money's gone. There's no money in there earning interest anymore. But if, for example, you have $10,000 in inside of your checking account, right? And let's just say for easy math in the bank, you're earning 1% interest. And then you have $10,000 on a credit card. Well, if you spend the money on the credit card, your $10,000 in your checking account is still there earning that 1% interest. It's the exact same thing with the IUL. I just feel like people get confused and they overcomplicate it just because it's inside of an insurance policy. So the accumulated value is just that. The accumulated value is your quote unquote checking account, savings account, high cash value savings account, and you're earning interest on that account. Now, how much interest are you earning? Well, let me move my big head out of the way and let me show you. So, for this specific index, let me make this a little bit smaller for you guys. The last 15 years, this policy has done 5.46%. The last 10 years, it's done 5.36%. The last 5 years, it's done 1.98%. So that's the actual index strategy itself. In terms of the interest actually getting paid into the cash value accumulation account, what that interest reflects is 17.08, 17.28, 11.74. Now you might be asking yourself, how am I getting these large numbers? Well, with this specific IUL, there is a 270% participation rate. All that means, again, just breaking this down easily so you guys can understand, this 270% participation rate is just a 2.7 times multiplier, right? So whatever interest that the actual policy is doing, it's in that year, the insurance company multiplies that by 2.7, which is, this is the actual interest getting paid into your cash value, which is in this column. Now, as you can clearly see, there's no reason to touch this money. You don't want to touch that money. You want to be earning as much interest as possible on the highest dollar amount as possible, because obviously you're going to earn, even if I am getting paid 10% interest and you're getting paid 10% interest, if I'm getting paid 10% interest on $30,000 and you're getting paid 10% interest on $10,000, I'm still getting paid a higher amount of interest because I just have a larger dollar amount. So that is why you don't touch this money. That's why instead you take loans from the net surrender value. You are now leveraging the life insurance carrier's money to spend the same dollar twice. So basically, again, for just an easy example, you put in $30,000 into your IUL. The insurance company is just going to match that $30,000, just also give it to you in the form of a loan, in the form of like a line of credit. And so if you really, really want to take advantage of this, what you would then do is go and take out these loans and go put them into income producing assets. So that, for example here, so that you're in year 11, your $318,000 is earning a 30-year historical average of 17.5% interest inside of the IUL. Plus, you were smart and you used this $318,000 to buy a car wash, to buy a laundromat, to buy, any income producing asset, single family home. Maybe you took that money and passively invested it in multifamily real estate. Maybe you angel invested that money into a business. Doesn't matter. You took that money and you invested it or put it into some type of income producing asset. So now what you're doing is you're earning interest on the same dollar amount, your same $318,000 in two different places. And what's really neat is that your income producing asset can pay back that loan, and then you can just rinse and repeat. It's just like a credit card. If you have a $10,000 spending limit on your credit card, you spend the whole $10,000, right? And instead of like buying, Louis Vuitton shoes or a Louis purse or whatever it may be, you use that $10,000 and you put it into an investment. That investment paid down that credit card to $0. Now you can go spend that, $10,000 credit limit on another investment and just keep doing that. And those investments will just keep paying your credit card down to $0. And then you'll spend that money again. And then that investment will pay that credit card back down to $0. It's the exact same process with this. This is why fix and flippers love the IUL, right? They'll take out a loan for $57,000 or they'll take out a loan for like $33,000 for the rehab of a property, right? They'll use that $33,000 to put in new hardwood floors, renovate the whole kitchen, renovate the bathrooms, do whatever, put in new windows in the whole house, and then they sell the house. With all the profit they made from the house, they pay back the loan, which means they have a full spending limit on that quote-unquote credit card, which really in this case is just a line of credit with the insurance company, and then they borrow again, right? And each time they borrow, look, it's getting larger and larger and larger every single time, right? And then plus, not to mention, this is only assuming that you're putting in $24,000 a year, right? Let's just say you took out $83,775, right? And you use that to purchase a home. You just use that as like a down payment for the home. In that case, it'd be like a multi-million dollar house. But yeah, let's just say you're a fix and flipper in like Beverly Hills, right? And then obviously you make your money back, that $83,775, plus obviously you made some profit on top of that. So you would not only be paying back the loan, but let's just say there's also an extra $30,000 that you put into the policy. That's going to reflect into here. So instead of being, 111, it'll be 142, so I hope that answers that question. The question basically being the title of this video: why borrow my own money in an IUL instead of just withdrawing it, right? I already explained the way that people phrase that question is incorrect. You should never withdraw money from the IUL. You should just take out loans so that you can continue to take advantage of the uninterrupted compound interest inside of this policy. If you guys want an IUL, if you guys want a properly structured high cash value IUL, there will be a link, a free IUL consultation in the description of this video to book an IUL consultation with me. I would love to run some illustrations for you, show you what this IUL could do for you and how this IUL could help you achieve your financial goals. If you have any questions, leave them in the comments, or again, just book a call with me and I'll answer them with you on Zoom. Please like, share, and subscribe so that you don't miss any more of this educational content. I also make content around investing in commercial multifamily real estate. If you are an accredited investor and want to passively invest in real estate, definitely check out those videos as well.